Good morning, one and all, and welcome to today's video. So today I have just the one pair on watch, and that is pound Swiss. So as always, I'm going to give you my thought process. I'm going to break this pair down for you and tell you what I will be looking for from it today. So we start off as always on the higher time frames. We do top-down analysis, not down-down analysis, which is what a lot of traders do. They start on the lower time frames, and that's where they stay, a lot of them, and that's why a lot of the time they're ignoring or disregarding the higher time frame narrative, if they even understand it at all. But that is well and truly another subject for another day. So on the higher time frames, the first thing that jumps out at me with my level of experience as it currently is this 1, 2, 3 touch structure. Now, generally speaking, when we have these 3 touch structures, and the reason we know it is a completed piece of structure is because we also have a middle section within there where the impulses are of a similar length. This, in my experience, is a completed piece of structure. Sometimes price comes down for a scoop double bottom, but that's less common. Okay, so generally speaking, when we have these 1, 2, 3 touch structures which have a 1, 2, 3 middle section, then on the higher time frames, the narrative is usually if we to break a trend line such as this, and we do so impulsively, generally speaking, we find our way to what we call the 90% rule, which is the start of the piece of structure. Okay, so that is the higher time frame narrative. But for us to reach the 90% rule, we generally break this trend line here. If we were to plot one there, once we break that, if we do so impulsively, we know we have a 90% chance of getting 90% of the way to the start of the structure, which is why it's called the 90% rule. So now that we're back above, crucially, now that we're back above this low here, that would imply that we can be looking for moves to the upside, because this is what we call mass psychology. This is what we call catching people the wrong side of the market. Okay, so we have broken below and broken back above this high here. So once that happens, that is what we call mass psychology. That is what we call catching people the wrong side of the market, who believe, many of them, what acts as support once when price is above it acts as resistance once we break below. Okay, as I've talked about previously, the media get hold of the fact that pound Swiss in this instance is at an all-time low. Okay, so this would have been an all-time low. We break below, and then people think it's just going to keep going. Okay, we see this all the time. With banks, for example, when we get a run on the banks, I remember the run on the Northern Rock Bank here in the UK, and the media were putting out a narrative that Northern Rock were in trouble, that it was losing money, etc., and everybody went to the bank to draw their money out, which caused the bank to collapse. Okay, people thought it was just going to keep going. In that instance, it did, because the bank essentially ran out of funds. Okay, but I said, if you, as I've said previously, if you think about this in terms of the housing market, these are discounted prices. So when price breaks, when we have these 1, 2, 3 touch structures and price breaks below here, if you don't know what you're doing, then your decisions will be fear induced, because you think this is just going to keep going, and so people just start selling. Okay, the investors, the people that are not trading, the people that are making money in this game are not trading out of fear. They're trading rationally and logically, which is what I'm doing. Okay, so when I see price break below a low such as this by way of a 1, 2, 3 touch structure, which has a 1, 2, 3 middle section, I'm thinking discounted prices. Okay, you will often hear, if you go on Twitter and you see these accounts that, or even on TradingView, if you see the accounts that look very professional and clearly treat trading as in a business-like manner, you'll often see them posting things like discounted prices. They'll actually say that in their post. So I just see this as a discounted price, and of course, the bigger players buy up these discounted prices, and then price moves to the upside. Okay, and you can even see, as I've said previously, where here in this instance, many people, I'm sure, would have seen this as a retest to get short. So they start getting short, and then they just get completely washed out. Okay, so this is what we call mass psychology, just going a little bit more in depth into this than I normally would, seeing as I only have the one pair on watch. So we have that 1, 2, 3 that breaks below this low and pushes back up, and then we have that 1, 2, 3 middle section, and then you see these are psychological patterns. Okay, so these things repeat themselves on multiple time frames a lot of the time. Sometimes there's no structure, no psychological patterns, and that's typically where we sit on our hands, those of us who trade the Falcon strategy, waiting for people to commit themselves, waiting for people to basically hang themselves, as it were, a lot of the time, because then that gives us the structures that we look for. Okay. And if we just zoom down to the daily chart, you can see the same thing repeating itself again. So I'm just going to remove that ray line there just to keep the charts clean and keep the analysis simple. So what do we have? We have the same thing again. We have that impulse correction continuation. Okay, so that's the natural ebb and flow of the market. Impulse correction continuation. Okay, and the things that stand out to me here are the things which I have on my chart, hence why they're there. Okay, so what do we have here? We have a sharp move down, followed by a sharp move up. That gives me a clue that there is a lot of liquidity in this area. Okay, and when we come down and we get close to it, but we near miss it, and then we come down, we get close to that low again, near miss it, that gives me a clue that we will likely find our way down to this area before moving to the upside, because there will likely still be a lot of liquidity in this area which needs to be tapped into, and is likely to some extent, to a large extent, what keeps dragging price down. Even here you see price move down sharply. It moves up, but it keeps being dragged down. What is dragging it down? Likely the liquidity that is still sat there, which keeps getting narrowly missed. Okay, so what happens? We break below here. This is a higher time frame liquidity point, and these higher time frame liquidity points generally get broken below before we move back in, as people get themselves caught the wrong side of the market once again by way of what we call mass psychology. So we do break below. Many people would have seen this as a retest. Okay, so they start getting short. You can see this a bit more clearly on the 4-hour chart, but we get that move there, and then people get washed out again. You've just seen exactly the same thing on the daily chart as you saw in the weekly chart with the previous structure. Okay, and what do we also have? We have, after the, it's usually the second touch, we have that. What's going on here then? Okay, there we go. Right, I don't know what's going on there. We have that 1, 2, 3 middle section again. 1, 2, 3, where the impulses are of a similar length. Within that, you can see the same piece of structure, so a similar thing. So these patterns that we look for are fractal. We have the same thing there. We have a 1, 2, 3, which breaks above here, catches people the wrong side of the market. Within that, we have a 1, 2, 3 middle section. So these patterns that we look for are fractal. They repeat themselves over and over because people repeat themselves. Okay, we even have this kind of 1, 2, 3 last legs. We have this 1, 2, 3 that breaks below here, and if we just measure the impulses, okay, you can see that they're of a similar length. Okay, indicating that these 1, 2, 3 touch structures are usually completed moves. Okay, so if we have a 1, 2, 3 which lines up with a sharp hook point where I would anticipate price moving to the upside, then that gives me a clue that we will likely reject from this area. Of course, if we got volume such as this, so if we got something like this, I'm just going to go into a bit more detail, but if this correction, for example, this is the bars pattern tool, if you're wondering, if this correction had formed down here, okay, and we had all that volume, and then we had something like this, an impulse correction continuation, then with that much volume sat just above here, I wouldn't be anticipating price to react from this area in the way that it did, because if we were to measure that, then that would take us all the way down to here, and this would imply that we were heading down to these lows here, okay, or much lower if we measure it on the break, because sometimes the volume can dictate how far we travel once we price breaks out of that volume. I wouldn't be anticipating this rejecting from here, but when we get a correction which is halfway between a potential 1, 2, 3, that gives me a clue that this is likely where we will reject and push up. Okay, so what do we have? We've now pushed up. We have that impulse correction potential continuation. And one of the things which is likely dragging price up is the fact that we have a near miss here, which failed to tap into not just this high, but this standout liquidity point there, implying that there is likely still liquidity in this area, which is dragging price up. And now that the liquidity that was sat down here has been filled and washed out, that liquidity that is sat there will likely drag price up, because when we got to that area last time around, price narrowly failed to tap into it. Okay, so these near misses are quite important. So you can see that impulse correction continuation. If we just measure the impulse, of course, if we do find our way all the way up here to take out this high, there will likely be further corrections which give us the volume that we need to push all the way up to here, if that even happens. But if we just measure what we've got at the moment, this impulse correction continuation, and we assume that the leg out of the correction is of a similar length, that would take us all the way up to here. And if we measure it from the break of the correction, okay, so we have an impulse correction continuation, because the correction itself can dictate, as I've said, how far to the upside we move as people that were trading within here bail out of their positions. The number of people trading within this that bail out of their positions dictates, or can dictate, how far out we move. That would take us up to these highs here. Okay, so that kind of ties in as well. So as I drill down, you can see that we are moving. You can even see it on the daily chart, that 1, 2, 3. We've had those 3 drives. First drive from this area, we come down again, second drive, and typically speaking, the third drive is the one that goes more often than not. So you can see the price left a footprint. Okay, so we have this move up, price left us with a footprint, we move up, we come back down. What happens? You may have noticed again that the second touch is usually a near miss. So the second touch of this structure narrowly missed the low relative to what the price action that preceded it. What do we have here? We have a near miss. So price got close to this low but didn't quite tap into it, implying that there is still liquidity there which needs to be filled before price can move to the upside. And generally speaking, if we just drill down, we usually move up in a corrective manner. Okay, so this was not a very impulsive move. If we just replicate the price action within this move and move it to the side, that, generally speaking, with the exception of this little candle here, is quite a corrective move up. Okay, so why is that likely happening? Well, if we fail to tap into this area, okay, if we near missed it, then the liquidity that is what was sat there is likely still there, or a large amount of it is. Okay, so if people this is what I call the FOMO leg. So many people that were waiting, that saw price coming down, they knew that this was their area of value, and this is where psychology comes in once again. It's not difficult for anyone with almost no knowledge to, if you ask them, you know, if you showed them support and resistance and you taught them that in like 10 minutes, and you said to them, right, okay, look at this structure, where is a good place to buy? If you just explained support and resistance in its simplistic terms, they would say, okay, well, here. Okay, so why does price keep getting to these areas of value? If price is if trading is all about technical knowledge, then why does price keep getting to these areas of value and then not quite get there and then move? It's FOMO. To a large extent, this is FOMO. People knew that they were supposed to wait for it to get down to this area of value, and then right at the last minute, they fear that it's going without them. Okay, they always think that many of them, the market is going without them. They think that the market did things to them, etc., etc., etc. They attach themselves to the market repeatedly because they think that the market, the brokers, etc., the banks have got a vendetta against them personally. Well, I'll tell you why that's garbage. Because the banks and the big players make up about 84 to 85% of all of the liquidity in the Forex market. Okay, the hedge funds, I believe it is, and the slightly smaller ones make up about 14 to 15%, and retail, which is us, even though we're not trading in a typically retail manner, we make up 1% of all of the liquidity. So don't flatter yourself if you think that the banks are hunting you, because they've got more than enough liquidity to move the market. They don't need your liquidity to move the market. When they trade knowing that the market will move. When we trade, We trade and in anticipation that the bigger players will step in. We do not have enough money trading the way we do to actually move the market in one direction or the other by a significant amount. So we're kind of riding the coattails of the bigger players because they don't need our liquidity to move the market. They have more than enough. Okay, but people attach themselves to the market. So when they think they fear that the market's going without them, so they were waiting for it to come down to this area. As soon as it started to move. So for here, for example, maybe here, many of them would have got in, and a lot of the time you can tell it's them because you get a lot of these low momentum candles. Why? Because they don't have a lot of money, so therefore they're not going to move the market by as much as the bigger players would. Okay, and also we have to factor in that as these people are buying, the orders that are still sat here and the orders that are being placed here, because many of the people like myself understand that this was not tapped into yet, so therefore it still remains a high area of value. We're placing orders in this area, and the orders that are still there are dragging price down as people are trying to buy it, which is why you get more of a corrective move up, and then price usually more often than not comes back down to take out these near misses or the areas that we near miss to before that bigger move to the upside can occur. And we also have that 1, 2, 3 middle section. Okay, it's quite a clear 1, 2, 3 move there where the impulses are of a similar length. Okay, and when I see sharp pullbacks, so when I see a sharp pullback like that, I ask myself, and then price moves up and we don't really get a sideways correction, I ask myself what caused this sharp move back. Well, it was sharp move down, and it was likely the orders that that were in this area and the orders that were being placed in that area. So just giving you more of my thought process. And with all of this in mind, what I'll be looking for today is the following. Okay. Now, another thing which stands out to me is the fact that typically speaking, we generally see, so this is a good sign, see these little tight corrections as we're on our way down. This is usually indicative of people getting out of their positions before that next move to the upside. Okay, so I talked about previously about the volume on the higher time frames. If there was loads of volume, excuse me, I just hit the microphone, I hope you didn't hear that. If we saw loads of volume like this coming in just above this area of value, then I wouldn't be looking at this trade today, because typically speaking, we don't normally see volume like that coming in just above an area of value if this is going to be the move to the upside. Okay, that would imply that we're going to break out and push a lot lower, which implies something a bit more complex. But when we see these little tight consolidations just above an area of value, that is a good sign, because that implies that people are just getting out of their positions. Maybe you caught the move up. People are getting out of their positions for that potential move that I was talking about to the upside. And generally speaking, I talked about this yesterday on pound dollar. Pound dollar sold off a little bit early, but it's actually sold off in quite a corrective manner. So I'm just leaving pound dollar alone at the moment. But typically speaking, if we see these tight little consolidations in this instance, on the flip side of pound dollar, if we see these tight consolidations just above the area of value, often they act as the left shoulder in a mini inverse head and shoulders pattern. So what we often get is a little tight consolidation just above the area of value. We'll often break below, break back in. We get something like that, and then we move to the upside. Do excuse the drawing. That looks a bit phallic, but that's a story for another day. So then that becomes the left shoulder, that becomes the head, that becomes the right shoulder, and then we move to the upside. Not always, but that's often what happens. So with that in mind, all of these things factored in, what I'll be looking for today is price to tap into this area. Although we do have a nice kind of 1, 2, 3 touch structure, because of the size of this structure, okay, I will not be looking to time the entry as such. This is kind of, we can even see this on the daily chart to some extent. So this is quite a large structure. So with all of that in mind, what I'll be looking for is, I won't be looking for a risk entry from the bottom as such. I'll be looking for price to tap into the low that it failed to tap into last time around. And if it breaks below slightly, that's great. If we then get the push up on the flag, I will be looking to get long on the break of the flag or within it. And I will be able to manage this even up to just this first inflection point for something in the region of 7%. Of course, if we move to the highs, there's a potentially 10%. And then if that higher time frame direction, which I was talking about, plays out, then it could be all systems go. That's what I'm going to be looking for from pound Swiss today. I hope you've enjoyed this video and the analysis which I've broken down for you, and I will see you again in the next video. Thank you very much for watching.